Hi, I'm Steve Clapham. Welcome to the Behind the Balance Sheet podcast, where we meet leading investors and commentators and educate ourselves about the world of investing and the world at large. Our mission is to remove some of the mystique around investing and improve our understanding of what makes a successful investment or indeed an unsuccessful one. Our goal is to inform, educate, and entertain. We hope you enjoy this and every episode.
Behind the Balance Sheet and affiliates and podcast guests may own shares or have an economic interest in securities discussed in this podcast, which is aired for your education and entertainment only. Nothing in this podcast should be construed as investment advice or relied upon for investment decisions. Always do your own research.
My guest, George Michelakis, in his youth was one of the top 3 under-20 chess players in the world. No surprise, he's pretty good at investing too. He runs a London-based $2 billion Longshort equity hedge fund that he founded in 2006. Since then, he has turned $100 into $535 versus $343 for the MSCI world. That's using a net exposure of 30 to 45%, which is pretty impressive. Even more surprising is that he entered his longest running short position not 10 months ago, but 10 years ago. We talked about his investing philosophy, his theory about a lifestyle recession, why shorting is critical to performance, how he manages the fund and the team, why he focuses on management, and much, much more. Some of George's insights come, I think, from having a different perspective on the world. We talked, for example, about why 7 Formula One drivers are under 23 because they're learning on simulators, and what this means for investing. Man plus machine was extremely powerful in chess, which George reckons is 20 years ahead of investing. And he shares some of what he's doing at Gladstone and how the role of an equity analyst will change. George clearly has an incredible brain, and obviously I was always going to struggle to keep up. But we had a fascinating conversation. Well, I was fascinated, and I'm sure you will be too. So, George, I'm really interested to talk to you because you're a chess international master. But what was behind the move to investing? Did you always want to be an investor?
I think I always wanted to be in finance. I grew up in a time where that seemed intriguing. Mm-hmm. And once I started in finance, I realized that I didn't want to be in finance and thought, well, what's close enough? And started in private equity.
Right.
And found that this was back in the late 90s. So
when it was still fledgling industry.
Yes. And found the process interesting.
Yeah.
Found the people, who runs these companies, how did they get to where they got to, why they're for sale, all of the dimensions just intrigued me.
Yeah.
And so that was my start in the investment business. And it was, I think at that time, it was somewhat of an offshoot from the world of finance. It was typically people who had come out of investment banks, started all the private equity firms. So that was my way into the business.
But why did you move to public equities?
So met some hedge funds, 2003, and I think the energy, the intellectual flexibility of it all, the depth of conception, it was far less checking that the cash flow number is really 200 and far more understanding where an asset fits into the world. And I think all those dimensions were new to me and very interesting. I think more intellectually challenging.
Yeah.
And so a little less about the diligence and the process, and quickly got intrigued by the short side. So all of a sudden you've got this new tool that you can use. Where private equity is actually, interestingly, a good training ground, because you talk to a lot of companies, you check a lot of the detail behind those companies, you check whether what they say is true and whether it matches financially. You understand business models. You understand how business models can go wrong because you're owning assets for the long term.
Yeah.
And these are a lot of the things that public market investors don't spend their time on. Not that they couldn't, it's just you tend to be more worried about, is this in the right sector, and is the next earnings per share up or down, and is the market going to like the fact that the balance sheet's getting more or less levered? So the focus tends to be more on the narrative, and less on sort of diligencing whether what's being said is going to be true.
It's funny because I do this forensic accounting course, and the slogan's numbers over narrative. And the private equity is much more about the numbers and much less about the narrative, because they figure that the numbers will take care of the narrative.
I think they're owning the asset for so long that the bet is that at some point there will be a narrative.
Yeah.
Which is why we end up with companies with 3 years of good financials. And if you somehow have a sense of what happened before those 3 years, it's often much messier. And so I think there's this patience, timing your exit, waiting for enough of the environment to be supportive and the management team to be on a good run in terms of execution, and then you can sell assets.
Yeah.
But I think as long as you can get that opportunity in the next 5, 7, 9 years, I think some of these investments are being held for longer and longer.
Well, they're being held for longer and longer because they can't get rid of them.
Well, they turned out to be less interesting assets.
Yeah. Well, of course, it's a much more crowded field now. And your fund, the Lasker Fund, is named after the former world chess champion, Emanuel Lasker. Now, I wanted to ask you, why him? We're going to come on to more chess in a bit, but why him and not, say, Kasparov? Lasker apparently was considered one of the greatest chess players of all time. But is chess an activity in which we can improve? I'm interested in this because, if you think nobody had run a 4-minute mile until Roger Bannister, and now 1,750 people have run it. We improve over time.
Mm-hmm.
Do chess players improve over time? And why was it Emanuel Lasker you named your fund after?
Lasker, I wanted something with more duration. So he was the longest world champion.
Oh, I see. Okay. Right.
And so that was sort of, as opposed to a style or a brand. And then, certainly chess players, are they getting better? I think they're changing because of the nature of technology.
Right.
There's more of them. They're younger. They're learning in different ways. So they're not learning the old Soviet school training camps and then some sort of super experienced world-class player trains you for weeks on end. They're doing it online, playing games, just volume of repetitions. So there's some interesting learnings from all of that. I think my sort of thesis is that the chess world is 20 years ahead of the investing world in terms of how humans have integrated with technology.
All right, we'll talk about that later. We're going to come back to that because I was interested. You were talking about how many Formula One drivers are now under 23 because they're learning in a different way. So let's come back to that because I think it's really fascinating. But I want to talk about the fund. And your investment objective is generate consistent risk-adjusted absolute returns across equity market environments with a typical net exposure range of 30 to 45%, and use a fundamental research approach to identify structurally value-creating and value-destructive companies and industries. And you focus on 7 factors to identify long and short investments. What are the most important factors in that cocktail of the 7? Let me read the 7 for the listeners. Governance, industry structure evolution, structural change, corporate change, balance sheet structure, capital allocation, and returns on capital.
Yeah.
What do you really worry about? I know you worry about them all, but what's the...
I mean, if there was one that I think is always relevant, I think, because I think at certain times in the cycle, different things will be relevant. During the GFC, balance sheet and capital structure was the most important. Didn't matter really who you were. But I think the most important is governance.
Interesting.
As in a permanent feature that permeates decision-making all the time. And it's something so subtle. Are these people making the right decisions, hiring the right people, running the business better every day as opposed to worse? And these are quite invisible to the eye.
So how do you evaluate that?
Meeting management from time to time, checking their track record. The firms now that assess management, making sense of their decisions and trying to really understand whether the decisions are what I would do. I think that's a great acid test. Would I be doing that? And why are they doing that? And so a little bit, I think in terms of training people, one of the hard things to do is to get them to think, what would you be doing if you were them?
But most people wouldn't have a clue. I mean...
That's true, but it's something you can learn. You can start to think more like the manager of a company and understand more what really they should be doing.
But that requires quite a detailed understanding both of the business and of the industry, doesn't it?
It can do. I mean, we don't do anything in commodities, but I would struggle to understand what a steel company should do, yes. But if they're in the sectors that we've tended to focus on, I can make sense broadly of whether somebody's doing something that adds up or has a realistic probability of adding value, as opposed to they ran out of ideas, or, I mean, the worst case example, I've seen a CEO buy a company in Australia, I won't mention the company, so that he could move his family there. So how's that for a great rationale for doing a transaction? So there's all kinds of things that happen in the corporate world, and just making sure that you're in the right quartile of stewards of capital / they're looking after, they're aligned with the shareholders, as opposed to the bottom quartile where, okay, it's a professionally hired team. Maybe this is their first shot at actually running a public company, and their incentives are not what you think they are, or they're not what they should be.
But that guy that bought the business in Australia, he didn't tell you that he wanted to move there and he wanted to move his family there, surely.
There was always something strange about the timing, the asset they bought, the reasoning. It never really resonated good industrial logic.
So you've been doing this for 20 years, which is pretty unusual for a hedge fund. And you've compounded at 10% market neutral, which I think is astonishing. Right? So that to the end of 2024, you delivered a 5.35 times return versus 3.43 times for the MSCI world. I mean, you're not on any magazine covers or anything. Have you been keeping a low profile? Is that you prefer? And what's been the secret behind that?
Yeah. Well, let's start with the latter question, because that's an easier one. Look, it's back to buying great companies at the right time. And the time point, everybody talks about buying great companies because that's an easy thing to talk about. Yeah. And the skill component is more the timing, when to own them, which is something that's far less explainable. And so a little bit people struggle with that. There are a lot of good books written about what is a good company, and less books written on when to buy a good company.
But don't you just buy them when they're cheap?
Well, the question often is, has the company actually been impaired? Or is the market cheap, in which case is there alpha? So it's a little more nuanced than just buy them when they're cheap. And often cheapness, there's normally a good reason for that. It's there's something that needs to change or some perception that needs to really alter. So getting ahead of that change in perception, I think, is really where the returns are made. And I think one of my team described it well. He said, we're in the business of buying and selling assets that are changing class. They're being, the long should be getting upgraded in their class, and the short should be getting downgraded in their class. And that's what we aim to do.
But that's quite tricky, isn't it? Because that requires understanding the business and understanding the market perception.
Correct. That is the challenge. And I think most people are good at one or the other.
Yeah.
And it's very rare to get people to think in terms of both at the same time. I have a sort of evolving hypothesis or thesis, let's say, around the human brain. We have two brains, essentially, a left brain and a right brain.
Yeah.
And they do different things. And most people tend to lean very heavily on one or the other. Now, the 80s, 90s version of that was the left brain's the logical side and the right brain's the creative side. It's far more complex than that. And there's actually been a lot of study around it. But there are truly two brains. And most people tend to be very overweight one.
Yeah.
Back to...
But you must be a very overweight one as a chess player, no?
Well, even chess players, I think you have different types. So they're not all acting more like computers.
Yeah.
Some are more feely and have a sense of what's going to work better. So I think that's, even there's the case of using both. You need to be able to calculate and have a positional sense. Yeah. Which is a bit like the market. The positional sense is, do I even want to be in this neighborhood?
Yes.
And the calculation is it cheap and the numbers going up, etc.
No, I've always thought that being an analyst in particular was a very creative job. And my wife laughs at me, when I say something like that. It's just about the numbers. But actually, the really good ideas are about the perspective and looking at things through a different lens.
And that's, by the way, sorry, just to come back to the left brain, right brain, they do, it's a case of they view the world differently.
Yeah.
So the left brain will see things in a very specific way.
Yeah.
And the right brain will see things in a very specific way. I think the market can get things wrong when it tends to focus too much on, very near-term numbers.
Yeah.
Or falls in love with a big picture theme and then misses that the company's misexecuting in the detail.
Yeah. No, I completely get what you're saying. So just talk about how you do it, the mechanics of doing it. Because you've got sort of 25 longs and 50 shorts sort of thing, and 120% long and 80% short.
Mm-hmm.
So you've got big chunky longs, 4 or 5%, I'm guessing, and 2% in a short. And is that about right? And why is that the best framework? I mean, you've just done this by trial and error or experience over the years. Has it changed much? I mean,
it has evolved, and we've spent a lot of time looking at our data. So to understand sizing, optimal portfolio construction, we run an optimizer that's took us a number of years to build, which helps define sort of where your alpha capture and your volatility.
So is that about sizing or?
It's, yes, mainly about sizing. And I think, again, the market can get very lopsided in how it's constructed its portfolios. And then when things change suddenly, everybody's going to feel the pain.
Yeah.
It's a question of how much pain are you going to take. So what sort of drawdown risk are you running? So a lot of data and a lot of analysis of that data. On the long side, I feel really owning the things you want to own in size is a much better way forward. than a 50 stock, 3% positions type of portfolio. So one of the asset tests is, I can see why there might be a long. Are we going to be able to own 5% of the fund in that? If the answer is no, there's typically something in the way. And again, you're playing probabilities. This is all a probability matrix. So over time, maybe that's a good investment today, probabilistically, but maybe the probabilities aren't high enough. Either the tail risk is too high. And so we're always looking to, if I can put 5% of my fund in it, then I know it's ticking a lot more boxes than what would only be a 3% position.
But you must be able to run much more than 5% if you've only got 25 longs, right?
Yes, but I'm using that as the hurdle.
Yeah.
The hurdle.
So how much would you have in a long before you went, oh, that's too?
I think we would be happy to go up to 10%.
Yeah.
So but that'll typically be truly boring companies. There's something quite permanent about those types of companies. We're not trying to buy 10% in a company whose earnings could vary dramatically.
Right. Nothing too exciting.
Yes.
Well, I hope you're enjoying this episode, and if so, you're bound to enjoy our free newsletter on Substack. It's a weekly email I send out each Sunday morning on interesting investing-related topics. Just visit behindthebalancesheet.com and hit that little sign up button on the top right. And while you're there, you should check out our fabulous online investor training school. Hundreds of students have taken our flagship Analyst Academy course, which teaches you everything you need to become a serious equity investor. And if you're a professional investor, we also run a forensic accounting course for institutional clients and a cohort-based course for smaller funds and for serious amateurs. Email me at info@behindthebalancesheet.com for more information. And you said you need 8 people because you need to generate a short idea every week and a long every 3 weeks. Is that kind of the price of entry to the long short world these days? Because you need an 8 to 10 man research team. I mean, it's a big commitment, right?
Yeah. I think if you're going to run 200 gross, which my belief is you should, and you're going to run a full short book, which my belief is you should, then yes, you need to be, and then you need to be able to organize that team. So it's not just, it's how much authority, how much accountability, how often do you meet with them, when do you review positions? There's all kinds of checks and balances that need to be incorporated. If you're doing something, a twist on that, let's say, which may have a place in the world, I don't know, then you can do it with a smaller team. I think if you're running a long biased, very concentrated long book, you could probably do that with 4 people, a PM plus 4.
But you need the numbers because of the shorts. So do you organize the team into long analysts and short analysts?
No. I think, I suspect that era is a little bit, we're probably going to move beyond that era of thinking. Again, gut feel. My sense is a lot of the process that short specialists sort of made their own is very process oriented, i.e. will lend itself to technology disruption.
Okay.
And rather what you should have is generalists who can embrace the technology and train them to be both left-brained and right-brained. It's back. So I find, coming back full circle to what I was saying earlier, the short-minded people are very left-brained, very process-intensive. Whereas the right brain is, I want to own this company because it's in the right place in the right time, and it's a good company, and maybe it'll become a great company. So different way of thinking.
It's funny because when I started in the hedge fund world, I don't think there was this idea of having a short team and a long team. And so I did both longs and shorts, and was probably equally bad at both. I don't know, but and I found that helpful because when you're out in the world, you see things that you would like to own, and you see things that you think, oh, I wouldn't own that in a million years. And if you're in a long only fund, you see many more shorts actually. So I think that it's natural. But then talking to people that have got short focused analysts, they found that to be very beneficial because the short guys have got those processes of finding the red flags and so on. And I'm quite surprised because I think that the world's going more in the short specialist way. And it's interesting that you do it differently.
Yeah. I think what we're talking about is simply, do you have a culture for shorting?
Yeah.
And a lot of people who, again, are right-brained, have a tendency to be better on the long side, simply lack the culture for it. Yeah. And then they sort of buy that culture in a sense,
right? Okay.
By hiring the expertise. I think the future is integrating both, which is not straightforward.
Okay. Well, we'll come back to that because I want to talk about an AI world, but let's talk about Europe because you mainly invest in English-speaking markets. You're 60 to 70% Europe, and the rest sort of US and other English-speaking geographies. And I read in your letter, you mentioned the 30 largest companies in Europe broadly kept pace with S&P 500 over, maybe not the last few, but over the last 10 or so years, which surprised me. And you're very bullish in the alpha spread in Europe. So can you just talk about that? Because I think that's a really, it's not something that people are familiar with.
Right. Which part is the
alpha spread, and
right,
and the fact that the large caps in Europe have done pretty well, right?
Well, one of the things I learned is that in Japan, when the Japanese markets were all over the show, there were actually good market neutral type funds that actually did really well through the 90s.
Oh, really?
Yeah, and that surprised me. But on reflection, if you can truly become agnostic to the beta,
yep,
there were probably, as a hangover of the roaring 80s, there were probably lots of reasonable companies to own, but also lots of over-levered, domestic-facing, problematic companies. If we look at what's happened in Europe over the last 15 years, and I think we need to recognize that the last 4 weeks have actually seen a dramatic change in that. But if you look at 15 years since the sovereign crisis, really European domestic has been a mess.
Yep.
The euro has been weak.
Yep.
Exporters have done well. And so that's provided a pretty clear playbook in that 15-year period, which seemingly has ended, as to how to capitalize on that from an alpha perspective. Own the businesses that have global product appeal, will earn dollars, have euro cost bases, and short companies that still face a pretty sluggish domestic economy. That's been changed somehow. It's over the last few weeks, or even maybe the last year or two, maybe the last year. I think we're seeing the result of that, or the culmination of that change in the last few weeks, where it now seems that European domestic is actually investable. Maybe not the consumer, maybe even the consumer might be investable. And the export companies are being challenged by the Chinese.
Yeah.
So I think what I've found in Europe is a very big dispersion in terms of the quality of the governance.
Yeah.
The really well-run private, family-owned businesses, for example, or companies that have got a tradition of creating value, tend to just do better than the parastatals and these quasi-government companies, and some of the small caps, I think, have essentially been run into the ground over time.
And you've got sort of sub-portfolios along sector lines or themes, and you've got sort of one long and 2, 3, or 4 shorts. How do you structure it, and why do you do it this way?
I think it keeps you intellectually focused on what you're saying through your portfolio, and means tracking whether that theme is really playing out, makes it clear whether that's true or not.
So can you give us an example of sort of, when you say a theme playing out, what sort of theme would that be?
Well, on the short side today, we're short. We think the consumer's in what's called I'm calling a lifestyle recession, where basically people are finding it just harder and harder to afford the life that they had before, and they're adjusting their spending patterns to reflect that. And so we're short companies that have taken too much price through the COVID period, where all the free money was given to people to stay at home, and have products and services that maybe the consumer doesn't actually need. I'm trying to be long business companies that actually offer value for money, for example.
But so you're long of Ferrari.
Yes. That's, well, value for money in that case.
Well, yeah.
That's a different idea. But yeah. I think Ferrari's, I think it's back to, we can talk about luxury. It seems to us that the idea of mass luxury is gone, but the one thing that's still alive is status.
Yeah.
And so just, again, the theme has changed subtly. Whereas before, the consumer just wanted to be part of the luxury world, I think the one thing that's permanent is the idea of status.
And do you not worry about the valuation of a stock like Ferrari? I mean, I don't mean to pick on that stock, sure. But it's a stock that I find quite fascinating.
Mm-hmm.
And I would find it very difficult to buy Ferrari tomorrow at this sort of value. I don't know what it is, but I know it's a big number, right? Because I think Ferrari faces an existential threat, because although everybody wants the car keys, the product is undergoing a dynamic change, because we don't really know what an electric Ferrari will offer over an electric Tesla, for example, other than the name.
Mm-hmm.
And in the past, it's had a lot going for it, because
mm-hmm.
it's had a very distinctive look, and it's had a very distinctive sound, and it's had a very distinctive performance. And all of those three things, I think, might change in an all-electric world.
It's interesting, because I empathize with that perspective, and we're actually short Porsche on precisely that idea.
Okay.
The difference being that there's 300,000 Cayennes,
yeah,
right? And that box of a car, which clearly was super popular for 15 years, is very easy to replicate, both in terms of the look and, by the way, most of the components are probably being made somewhere in Asia.
No, absolutely, but you don't have the badge.
The difference being Ferrari makes 14,000 cars.
Yeah. There's
a club. There's a waiting list. To get one of the special Ferraris, you need to be a repeat buyer. It's more of a club membership, and it truly offers status. I think your argument, which I'm in agreement with, which is that the EV form factor essentially will make everything seem the same.
Yeah, well, I know it's funny, because when Luca was in charge, 3,000 was the kind of thought of as the ceiling for production, and we're now sort of 4 times that, and presumably, they could go even higher. I mean, we don't know, but I don't really want to go into the detail of that, because it's probably a conversation that I'd love to have with you once we've stopped recording. But the on the themes, you make money in almost all of these themes or sectors or geographies Is it very important to you to have these, to have each unit being profitable?
Yes,
Why is that?
because if you think of the portfolio from a kind of buckets of a long and some shorts, but somehow they're standalone. Why would I want any one of those to not be profitable? Now, the way I think about it is, if the majority are profitable in a given year, our slugging rate, i.e., how much you win when you win versus how much you're losing when you lose, is also very high. And so I just need 50+% of those buckets to pay off, and then to get the slugging rate to do what it's done historically, which is to really capture the wins when you're right and minimize the losses when you're wrong. So to me,
the rate's much higher than 50%, isn't it?
Yes. But I'm saying you can have a pretty reasonable year just getting it 50-50. But I'm watching very carefully to make sure those themes are playing out as expected. And if they're not, I don't need to be right. And I think that's something which gets in the way of returns, this idea that I'm going to be right eventually.
Yeah.
So we tend to stop ourselves out of those sort of subsector views, if you like, and just say, oh, I don't know why, but Ferrari's underperforming Porsche. It's too sustained, too persistent.
And how long will you wait? I mean, how much pain will you take before you just say, oh...
Well, we run to a number. So we actually have a percentage by subsector. And if the drawdown hits that number, we're exiting. So,
and is that the same for every subsector, or it varies according to the theme?
It tends to be the same. I think in certain cases where the subsectors are lower volatility, we'd give ourselves higher volatility, we'll give ourselves a little more room.
Yeah.
Just because there could be more
noise.
Yeah, exactly.
And how long will you own a long?
3 years on average.
On average, 3 years.
Yes.
Yeah, that's quite long. And how about a short?
The average is around 15 months.
Great, that's really quite long.
Yes. And well, what's really interesting on the short side is the one consistent feature of the portfolio is that if you said what are the most aged positions, they tend to be the shorts, i.e. the 5 names. Now maybe that's because we have more shorts than longs, partly, but it's also problems don't get fixed easily. And so when there's something wrong with the business model, but this is a kind of meandering short. So the names today that are over 10 years old are shorts.
Over 10 years old?
Yeah.
So you have owned shorts for more than 10 years?
Yes.
Crikey. And what do? Do you just keep topping up?
Well, if they keep going down, yes. So we'll keep them at a specific size. And if they go up a bit, we'll trim. So we'll just target a certain size, which is back to the data set that I described earlier and mining that data to understand what the size should be. Now,
I know accounting is an important element for you. You said if I have to pick one leading indicator in the short side, it's aggressive accounting. It tends to be symbolic of a management team that's trying to prove better than it really is. Why don't people spend more time in this? Because, people look at me like I'm some sort of geek or something. Mm-hmm. And why don't people understand this? Because it's not a generally held view, right?
I think it talks to, I call it the post-fact world. This is kind of facts are slightly irrelevant. Let's just talk about the narrative.
Yeah.
And a little bit, it does become important in bear markets. So when
we haven't had one of those for a while.
Right? Yes. So I think people then pay a lot more attention to accelerated recognition of earnings and I don't know. It just feels it doesn't feel like the fun part of the business to most people. The fun part of the business is kind of watching a stock go up.
Yeah.
But if you compare this to, I don't know, football, the fun part is scoring goals. And I think the best teams are just as good at defense. And as I say, as I say repeatedly, the worst football team in the Mongolian league scores goals. They're still the worst football team in the world. And so a little bit, you need to get both sides right. I just think the fun part is scoring goals and not defending.
A number of your shorts have had accounting issues. So you were short of Carillion, you were short of Wirecard, you were short of Silicon Valley Bank, you're short of Credit Suisse. Do you think it's more prevalent today? Because I think that there's a lot more earnings management going on.
I don't have a great sense of whether it's that much more prevalent than before. I would say the opportunity set is as ripe as it has been. I don't see any change. I haven't noticed any particular change. But again, when the sun's out, no one cares. It's kind of like, what it's the analogy I would use. It's like having security in your home. If it's the middle of summer and during the day, do you really need an alarm system? I mean, everybody's just walking around and happy. I think it's when it gets late at night, and that's when you suddenly go, maybe I should install an alarm system. So I think management teams want to impress. They don't want to disappoint. They want to keep their jobs. They often have shorter lifespans than we realize. I mean, I'm sure you've been in the markets for 25 years. I've been in the markets for 25 years. The average duration, if you exclude the super long duration CEOs, is probably 3 or 4 years. So they just don't have the time to prove themselves. And so what's the quickest fix? The quickest fix is pulling out an accounting number.
Yeah. And there's no point in investing for the future because you're not going to be around.
They're probably not. Again, often this is coming at the end of their careers and are seen as a promotion that they've earned, which is probably a little bit upside down. I think the one thing I would like to see is younger management teams.
The average S&P 500 CEO is probably 55.
Yeah, but what's that in Germany?
I don't know.
Probably not 55. So I think just bringing in youth to reignite innovation, as opposed to making sure that things continue to be done today as they were yesterday. I think that what we're seeing is things are changing quicker, more quickly.
Yeah.
I would say that the younger generations really do see the world differently. They're buying differently. They're experiencing differently. They're looking for different things for their money. And so consumerism is changing. I think if the corporates aren't aligned with that, they're going to struggle. That's what we're seeing, I think, in the consumer world today. Just changing preferences.
That's interesting. So, look, just talking about the hedge fund industry, I mean, I imagine you've got quite a lot of respect for the pod shops, but the growth of the pod shops and the algos have changed the way the market works quite a lot. I mean, how do you cope with sort of the extra volatility around results and that sort of thing? And I mean, is it a bad thing?
I haven't sensed that it's a bad thing. I think one needs to be a little more aware of the trading into the numbers, let's say. That often the pod shops have got access to data, or they're seeing something, they're being a little more precise on exactly what the change in euro or dollar or sterling or some foreign exchange.
Yeah.
So they've modeled this thing a little more precisely, and I don't see a big problem with that. Where I do see a little bit of an issue is where there's crowding, as you've seen in these US sort of capex stories around AI, and then the company beats by 3% and the shares are down 10 because people were expecting a beat by 5, and now that becomes a much harder area to manage.
So how do you do that?
I think my interpretation, frankly, is that crowding is probably telling you something else, which is everybody already knows everything. And so you have to be careful about what people aren't. You have to think, what could people not be thinking about at this point?
That's quite tricky, though.
Yes. You've got to alter your perspective back to get out of the left brain, which is telling you that there's a beat or a miss, or the balance sheet is extended, and all the good factual extrapolations that we can make, that are spreadsheetable, let's say, and shift to how could this be changing in a way that I can't put in a spreadsheet, that's making it less obvious than it was before. So, for example, DeepSeek came along and showed that maybe you didn't need to spend as much money, and tougher questions were going to be asked about ROIs of all the hyperscalers. And that's all you needed to know to realize that the upgrade cycle for this CapEx build was probably done.
But any halfway sensible person could have asked that question before, but the stock market was completely ignoring it. I mean, if I was trying to explain this to I always try and think about, if I was trying to explain this to somebody that beamed down from Mars, and I say, well, you got these, really successful tech companies, and they're full of cash and they're generating massive returns, but they're now throwing huge pots of money down the toilet because they're hoping that something's going to happen, and they can't all win. So, in the aggregate, you would expect the shares to go down, because if you're burning $300 billion without a hope of getting anywhere near a sensible return on that, which seems to me highly unlikely, then, if you'd painted that scenario, you would expect the shares to go down. But the shares haven't gone down because everybody's very excited. But it's very difficult to explain that to the Martian. How do you sort of make sense of this world then?
I mean, there's a lot of sub-points to what you've stated. The question is the ROI, and then there's a counter argument. For example, that Meta, who were early to adopt AI, have exhibited an extremely high ROI on that spend. You could argue that Amazon is simply building capacity for inferencing. They're not really throwing money down the toilet. They're just making sure that they'll have the inferencing capability. They've all got their own decision tree, and one needs to understand specifically who's doing what and what the ROI.
You're very polite. You can tell me that I'm talking rubbish. I mean,
I'm saying this. You could make that argument for certain other companies, where it's less clear. I'm saying, and I think a little bit, I think that argument was being made for OpenAI, where the spend is just so high. The revenues are lagging. And I think Microsoft kind of went, maybe the government could fund that instead of me, right? So logic prevailed, or industrial logic prevailed. So you can see why Microsoft's sort of stepping away from funding OpenAI in an open-ended way. I think you've got to understand each of their decision-making the tree, the decision-making tree.
Yeah, and you know, I mean, I own Meta, and I think it's got a massive opportunity with all this. I mean, I kind of get that, and I've kind of sort of been more worried about Alphabet, because it seems to me it's kind of hard for it to get into a better situation than it was before all of this, and in order to even keep close to its present or previous situation, it's got to spend a lot more money. So in the end, it's hard for me to see Alphabet ending up worth more. So I don't know, but we don't want to talk about these stocks because everybody talks about these stocks, and I'm much more interested in talking about what we can learn from chess, because chess has been human plus machine for a very long time. And I used to work with someone that competed in the, I don't know what you call it, the computer-assisted chess championship. So the human plus machine. So what do we learn? I mean, you keep quoting Gary Kasparov. Human plus machine isn't the future; it's the present. Those who adapt will be successful. Those who do not will fail. How are you adapting, or how should people adapt? Because you don't want to tell people your secrets. But
I think I've had the value or the benefit of having watched the chess world evolve.
Yeah.
In 1985, they had these sort of plastic, essentially part plastic, part some computer program, but very primitive computer program, promoted, by the way, by Kasparov in 1985. But they were very much for kids at home. And that by 1990, you had something on your desktop called Fritz, which any half-serious player was using. By 1995, Kasparov lost to Deep Blue.
Yeah.
By 2000, everybody was using machine pretty much for everything.
Yeah.
By 2005, even relatively weak machines were better than the best players in the world. So and by the way, that's already 20 years ago.
Yeah.
So what's happened in the next 20 years is people adjusting to how to become symbiotic with the machine.
Mm-hmm.
And I mean, this sounds far-fetched, but literally, I think the kids who grow up using the machines have their brains wired differently. It actually fires different synaptics. Really? And creates a different brain structure. And so a little bit, I think what you're looking for is a generational shift that will use all the modern technology more. It just is. You know, as I remind people, when you go home, do you turn on the light and say, "Oh, that's technology"? You grew up with lights.
Yeah.
It's technology, right? If you had to go back a couple of 100 years, you'd have to teach somebody how to turn on the lights.
Yeah, of course.
And so I think it's building an organization that's symbiotic with technology in a way that's not thinking. I don't believe there's a mea culpa, or I've developed a screen that's using Llama, Anthropic. I think it's building an organization that's far more cohesive with the state of technology today.
But I mean, we sort of take the example of the Formula One drivers, and so
Mm-hmm.
they're all on the simulator, and they know the circuit before they get there, and all of that. And you think this is happening across disciplines? People are demonstrating they can leverage new tools to improve their craft to a level that used to take much longer to hone. So what are the implications in the investing world? I mean, what will a junior analyst be doing in 3 years' time?
Using AI to do what the analysts 3 years ago would have had to do themselves.
So how do you train? So lots of young people, I mean, a lot of professional investors into this podcast, but also a lot of young people. So, what would I tell my 18-year-old son? What should you be doing? He doesn't want to become an investor.
I think the firms have to offer the training in-house and have the tools and that you've got to build the simulator, essentially, right?
Okay, yeah.
And you've got to get people at the point where they're happy to work with the simulator for a couple of years and learn from the simulator. Whereas this used to be a craft where you'd have to spend 5 years with a very strong investor.
Yeah.
And somehow through osmosis or observation, understand things that were not easy to learn.
Yeah.
I think machines will offer that opportunity in a different way.
And I mean, what's been your experience at Gladstone? I mean, the team all said, "Oh yeah, I can't wait to type my questions into ChatGPT or the Gladstone equivalent of it." Have there been people that have said, "Well, actually, I don't feel really comfortable about doing that"? And how do you, as a teams, kind of sort of work out what this works, that doesn't work? It's one of the things that I've found. I've tried to deploy this technology because I'm obviously old and I need to understand how it works. And there's quite significant differences between the different tools even. And it's not necessarily evident unless you're deploying them in particular context. So how have the team found this? And are you sort of cracking the whip saying, no, you can't do it in an analog way. You've got to do it in an AI way?
I don't think you can crack the whip. I think I think what you're talking about is setting a culture internally,
Yeah,
where people want to.
right.
It's back to you don't think. My favorite example is the microwave, and just trying to get your grandparents to use the microwave in 1985. That's probably not going to happen. But yeah, the youth today can use a microwave and are very comfortable using a microwave, and they don't even think about why would you question that? So you need to align the organization with people that are just comfortable with the idea. I don't think you can make people comfortable with the idea that are inherently comfortable with the old idea.
And when you're recruiting, is this a big component of the recruitment process? Because you recruit a lot of people, right?
Yes. No, it's a very important component. So we're always looking for people that are more aligned with that vision of just embracing technology.
And I'm conscious of the time. I wanted to just briefly ask you about management, because you touched on it, but it's a big thing for you, and you think there's a lot of overlooked source of information. Just talk a bit more about that. I mean, and how do you control? So you say, okay, we meet management, but I've always found that once you get to be CEO of an S&P 500 executive, you're very good at sales. How did you get around that?
Yeah. I think it's training the team, talking about cues, getting people to focus on it. I think again, most people just gloss over that idea. I think when there's some error or leading indicator of something that's not quite right, acting quickly, recognizing what it is. I think I was very fortunate to have started my career in private equity, and over the course of almost 5 years, I met at least 500 management teams.
Oh, really?
Yes, and so it was a particular experience. We were focused on financial services. We were the only people focused on financial services in Europe, the only private equity firm that did that for a living. And so I just got to meet one management team after the other. It would often be one or two a day, depending on exactly what was happening. So I think I've built up that skill set early on. I do recognize that most people struggle with it. They just don't even know where to begin. So I think it's just making that part of your process. We've already built some AI that goes and looks at, does this team hit the numbers? Do they sound optimistic and then pessimistic? Is there consistency in what they're saying and what they're doing? And again, these were early iterations of any such tool. But the point is, if you know what you're looking for, you can get a machine to at least do part of the heavy lifting for you.
Interesting. And that's using natural language processing and that sort of thing.
Exactly.
Which we couldn't do before.
Correct. So this is no longer just a series of data with numbers that we're now going to put a linear regression model and say, that's a signal. This is a machine that can actually see the words, understand inverted commas, of course.
Yeah.
But pick on words and then see whether the actions are consistent with that.
And how are you going to balance the sort of left brain, right brain? Because it's people, right? It's very touchy-feely, but you're trying to make it also a data-driven exercise.
Yes. Well, I think this is where the large language models are somewhat capable of even replicating parts of our right brain, because this is what these are neural nets in a sense that are copying the human's brain.
Yeah.
The easy stuff is, can you calculate EBITDA, which is a left brain thing. The harder thing is they said A and then they did B. How meaningful is that? Do we need to care? They sounded optimistic and then missed numbers. Do we need to care? But they're capable of absorbing so much more of these cues.
Right. Interesting.
As opposed to, it'll take an analyst 2 weeks to do something which a machine can do in an hour.
Yeah. So will you be sort of recruiting more data scientists, and will you become more sort of computer heavy?
I think yes, but balanced. I think, again, back to we're looking for man plus machine, not machine plus man.
And how it's quite tricky, isn't it? Because you're sort of at the leading edge, and you've kind of got to be at the leading edge. But how do you assess how good you are? Because you don't have the learning curve, you don't have the experience.
Yes.
It must be quite tricky, isn't it?
Yes. No, I think it is, and I'm not pretending to myself that we're on the leading edge. I think we're saying, this is where the future is. Let's make sure we're there, and let's keep learning. I think when you think you're on the leading edge, that implies that you've got some answer to something. And again,
but by definition, you are, right? Because you're doing this, and not everybody is.
I'm saying that's not the mindset. The mindset is not to think that somehow that means anything, right?
But I mean, you must be you must be a pretty confident person, because you started this business quite early on in your career, right? You hadn't been doing hedge funds for that long, and then you were backed by Ted Seide's protege partners, and you bought him out quite early on when you still didn't have much AUM. But you don't sound terribly confident. You're quietly confident. What is it, George?
Look, I'm a believer that when I see things clearly, I do see them clearly, and but I don't pretend to see things clearly all the time.
Right.
And so I keep a very open mind as often as I can, as much as I can, about as many things as I can. And when I see something clearly.
But what was it you saw clearly that gave you the confidence to set up your own firm?
What I saw clearly was that the industry had to continue evolving, that For example, on the short side, there was not as deep commitment to getting the short side right, that the industry was in Europe was behind the US. It still is. So that hasn't changed that much. So there were a few things that were very clear to me that us did need to change, have changed somewhat. I'd say the gap between the firms that are still doing long-short equity in Europe and the US firms is now much narrower. But that what I didn't expect was that the number of firms in Europe would shrink dramatically doing long-short equity.
And why is it you've been so successful at the short, and why do other people find it so difficult?
I think it's easy to make mistakes on the short side where there's a host of them that I keep seeing being repeated. I would go with one, some earnings headwinds equals a short. Yeah, that doesn't tend to produce much alpha. Two, being overly thematic. Yeah, but all these companies are going to be in trouble, and that's the most expensive one. Luxury's in trouble, but Hermes has retained its super multiple. Autos are in trouble, but Ferrari's retained its multiple. So to be too thematic. Three, and this is a good one. I think if you're shorting after the big leg down, I think alpha is elusive. You need to be there at the right moment to capture the alpha, the rump of the alpha. And so you need to be committed to the exercise of shorting in advance of it happening. So you need to be minded that way. Back to, you need the short culture. It can't be an afterthought. Again, it's not as much fun as picking longs, and it's a more blue collar, process oriented, detail oriented, and painful exercise.
Yeah, I mean, my experience was that you got a limited amount of pleasure for the 4 shorts that went wrong, and an unbelievable amount of pain for the 1 out of 5 that went right. So went against you, obviously.
Yes.
So the shorts that went down gave you a bit of pleasure and a bit of money, and the short that went wrong cost you a huge amount of money and a huge amount of sleepless nights. And so I never thought it wasn't a net enjoyable experience for me. I always found it, because you have to be much cuter in the timing.
Yes.
And that I found was more difficult because I wasn't as good at the timing. Whereas in the long, you can be out on the timing and you can just build the position more slowly.
Yes.
And average down,
Yes.
check, and
Yes.
do all of that. But that's the averaging up on the short side. I always found.
Well, here's
much
the
more difficult.
interesting thing. Hit rates on the short side, you're not doing badly at 50%. Yeah? So if you get 1 out of 2 that works as opposed to doesn't work, I think you're doing pretty well. I think where people have struggled, but is the essence of the short sell business, if you like, is the slugging ratio, i.e., when you get it right, make sure you've captured as much of that as possible. And when you get it wrong, being quick to exit. And I think part of the challenge is it's people that are curious in a certain way and intellectually dig in certain places, but then they lack the pragmatism of, Wirecard, we were short in 2016, at the beginning of 2016, and had to throw in the towel.
Oh,
It
really?
just it was just it was too early,
Too painful. Yeah.
and came back at the end of 2018, and so which was the perfect time. So this timing dimension and recognizing that this is maybe a great intellectual idea, but a terrible commercial idea, and recognizing those are two different things, it tends to be where people get stuck, that they fall in love with the intellectual side of it and then miss the commercial side of it.
And also, you're just worried that you'll miss it because if you close it and you know, with something like that. So with Wirecard, famously, John Hempton lost money, and he was the guy that gave Dan McCrum the original idea. And you know, I've interviewed Dan. He sat in that seat, and we published the interview the day the book came out. And he's, you know, the story is a fascinating story, but there's always a worry, isn't there? If you know that it's a fraud, you know it's a bad thing, and you think, well, if I close the short, then tomorrow it will be in the FT and the thing will collapse. There's always that temptation. How do you get over that?
Yeah, data, stop losses,
Yeah.
you know, just be way less emotional about these things, and just make sure that, again, the intellectual, it's also having intellectual confidence to recognize that it's not that your mind is wrong, it's that there's a commercial dimension. You know, it's a bit like, I don't know, this AI stuff. People have been working on it for 10 years, and it sort of had its moment when ChatGPT arrived. And before that, there was almost no point in talking about it.
Yeah.
But it's grasping the commercial relevance of your intellectual insight and having the patience to say, it'll happen, but
Keep an eye on it.
Exactly.
Listen, it's been fascinating talking to you. We always ask people to recommend a book to a young person thinking of coming in the industry.
I'm going to recommend something a little bit unusual, but it fits in with what I've been talking about. And there's a book called The Divided Brain or Divided Mind by Ian McGilchrist, which talks about the two hemispheres of the brain and what their various functions are. And
it's very funny because 2 months ago, we had an interview with Tom Slater, who manages Scottish Mortgage, and he was talking about that same book. It was a book that you happened to be reading. Yeah.
Did you recommend it? Or
he recommended a couple of books, and that was one of the books he recommended. So that's good, but it's fine because it's even better to have the same book recommended, because it means that I will now go out and buy that. I've got a huge reading pile, which I've now moved to the office, and I had them build me extra bookshelves because I'd run out of bookshelves at home. So I've now got bookshelves in the office here, and I can tell that we're going to run out of shelves. Listen, it was really interesting, fascinating talking to you. I really enjoyed the conversation. Thank you so much.
Thank you.
I thought that was a really fascinating conversation, and I am not surprised at how successful the Lasker Fund has been. George has what is essentially a fairly simple investing philosophy, but like many simple formulae, the practical application is considerably more complicated. I'm not sure what you or I can take away from this and apply to our own portfolios, but George talked a lot about data and studying past performance. It's clear that learning from mistakes is an important element of the Gladstone success formula. They are clearly expert shorters, so it's interesting that they are a training client of Behind the Balance Sheet. And that willingness to learn and improve is something I have observed at a number of successful investment funds. People who are confident in their views, but open to listen and learn from others with a different idea, or simply to learn. After the interview, we had a chat outside the office on one of those lovely, crisp, cold, sunny winter days in London, and we had a debate about a stock we both had an interest in. And I then understood what makes George a great investor. I wish we'd had that discussion on mic. but perhaps I'll write it up in my Substack. You can sign up for that in the top right of the homepage on behindthebalancesheet.com. Thank you for listening, and don't forget, please leave a 5-star rating on Apple Podcasts or Spotify. It really helps us spread the word. Thank you. Thank you for listening. I'm Steve Clapham. That was the Behind the Balance Sheet podcast. Please don't forget to subscribe to the YouTube channel. And why not visit our website, behindthebalancesheet.com, where you can find the show notes and lots of other videos which can help you on your investing journey. Thank you for watching.